We are back with Lyle Stein. He's president at Forvest Global Wealth Management. He's talked to us about the macro backdrop. He's talked to us about gold. He does hold it, both exposure to the metal and corporate mining stocks, at least one big one, Agnico Eagle. Let's talk more broadly about portfolio construction and how investors should be thinking as they've watched markets plunge this year, and interest rates are also down.
Yeah, it's a really interesting question, but it's at this particular point in time, people are needing more and more income as the inflationary pressures of what we've gone through over the last few years and potentially further inflationary pressures from the tariffs come into play. And now the pool of assets that's generating that income isn't as big as it used to be. So when we look at client portfolios, when we construct portfolios, we call it our 3C approach. We look at how much comfort do you need? One of the C's. How much protection against calamity do you want to have? That's a C. And then the third one is children and charity, and that's the growth component. But instead of thinking about equities and debt and cash, we think in terms of comfort. How much income do you need? So when we sit down with our clients, and particularly older clients in retirement, nearing retirement, got to think about where is the certainty of that income coming from? So we focus on that first. Then how do we protect that stream? That's where gold comes in. That's where things like inflation index bonds come in to protect you against the two major factors that hurt your portfolio, inflation and the governments.
Talk to us more about those inflation-protected bonds. What do they called, and what do they look like?
TIPS in the U.S., real return bonds in Canada, and they generate a return to you when you buy it of 1 to 2 to 3%. At the peak, I think it was 4. And then as inflation goes up, they adjust the payment to you, and your principal return at the end of the term on the bond is adjusted for inflation as well. So if inflation's up 20% from when you bought the inflation index bond, you'll get $120 at maturity. And in the meantime, your coupon payment is ratcheting up. It was a great place to be when we had that big run up in inflation during the spike that came during the pandemic, and we protected portfolios that way. We stepped out, and I don't really recommend long-term.
Right. I was going to ask, when are they not the right option? There's always a downside. When are they not the right option?
They're not the right option as real interest rates are rising, and that today is one of our biggest investment concerns, with a real interest rate being basically the nominal rate on your bond less the expected inflation. So people think a 4% government U.S. Treasury bond is 4, but their expectations of inflation are 2. You get a 2% real return. But if that 2% real return suddenly rises to 3 because of unknown concerns about tariffs or fear that there's too much debt being issued, as that real return rises, then your bond value falls. They're a complicated defense mechanism, but we've been following them for years, and so we use them that way.
What about good old dividend-paying stocks?
The best place to be. I mean, at the end of the day, dividends not just contribute to that comfort, contribute to that income that we need, but dividends can grow, and that's really important. And good companies, we're talking blue chip companies, that can grow those dividends can survive all kinds of bear markets. And so through this piece, when you look at our portfolio, I mentioned gold. Our second biggest exposure is to what we call reliable dividend companies, pipelines for the most part. And then our last component is a few hard assets, but we have preferred shares in there too that also yield 6% plus. So that's how we meet that comfort component of a portfolio.
What about U.S. dividends, which don't get the preferential tax treatment in this country that Canadian dividends do? Do you invest in dividend payers in the U.S. at all?
We have one dividend-paying stock in the U.S., Huntington Bancorp, which is now yielding comparable to, if not a little bit above, a Canadian bank stock. And we happen to like the way they're postured in the middle of the U.S. It's Ohio-based.
And what about, to go back to an earlier question I had in our first conversation, what about geographic exposure? Have you made any changes there? Do you have any significant exposure in Europe or in Asia?
Actually, Europe was interesting. So when we look at Europe, something struck us. And when you think about what's the most important commodity that any government could have now, it's the ability to borrow. One of the big issues in the U.S. is where are they going to come up with $2 trillion? Well, in Europe, the German government, because of their, I would say, very, very conservative fiscal positions historically, have a lot of borrowing capacity. And they went out and they said at the beginning of the tariff wars, we are going to spend €1 trillion on defense and infrastructure. And they can do that comfortably. So they're the king of the hill when it comes to issuing paper. We moved money from Japan, where we were worried about the tariff impacts on the Japanese export economy, and we shifted that money into Germany. This is a long-term trend, and our question now is, where do we want to be relative to that sort of 70% U.S. North American benchmark with our exposure? And we're going to slowly move to places in Europe. Buy the ETFs first, pick second the best names.
Always great to have you here, Lyle. Happy Easter weekend to you and your family.
Happy Easter to you, Paul. Thanks.
Lyle Stein was our